most REITs are today in a strong position to keep growing their dividend payments, and that's because dividend payout ratios are historically low at about 75%. REIT leverage is also at an all-time low with loan to values of about 30%. Now the Fed is also starting to cut interest rates, which will boost the cash flow of most REITs. And then finally, we expect rent growth to accelerate in 2025 and especially 2026 for most property sectors, because the growth of new supply will come down very significantly. But the REIT world is vast and versatile with over 1,000 companies worldwide, and just because we expect the sector to do well overall doesn't mean that every single REIT will be able to grow their cash flow and their dividend. On the contrary, there is a minority of REIT that are facing significant headwinds and are likely to cut their dividend in the near term. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss 3 REITs that I expect to cut their dividend potentially later this year or next year or even in 2026. I cannot predict the exact timing of the dividend cut, but I don't think that their dividend payout ratios are sustainable. Avoiding losers is just as important as identifying future winners, and dividend cuts have historically in the REIT sector resulted in significant capital losses. Before I go into the first company, I want to let you know that we're planning to do a REIT CEO interview soon on this channel, so make sure to subscribe if you don't want to miss out on it. So the first REIT I expect to cut its dividend is called Brandywine Realty Trust. Its ticker symbol is BDN. This is a popular office/life science REIT, and it's popular in large part because it's offering a high dividend yield. Last year in a separate video, I predicted that its dividend wouldn't be sustainable, and that's because it has quite a bit of leverage. It has a very big development pipeline that's on the way that it cannot stop, that's draining its cash flow. And then finally, it owns a lot of office buildings, especially in Philadelphia, which is a market that's struggling. And while many of these properties have leases on them with years left, and that's providing steady cash flow, I expect them to face growing issues and growing capex, especially as those leases expire and they are forced to reinvest in their properties to attract new tenants. And well, I was correct. Just about a year later, the company cut its dividend yield. But the issue is that I fear that they didn't cut it by enough, and I think that we'll have to cut it once again. Right now, the dividend yield is about 9%, and if you look at the payout ratio based on its FFO, it seems relatively low at 65%, and this is reassuring a lot of high yield focused investors that this dividend should be sustainable, especially since it was already cut once. But I'm going to predict today that this wasn't the last cut. They will likely have to cut it once again in the near term. And that's in large part because today the vacancy rate in the office sector is at an all-time high at about 20%. This is expected to reach closer to 25% in the coming years as more of these long-term leases expire. And this will lead to an avalanche of capex for office building landlords, including Brandywine. And if you adjust for this capex, the payout ratio actually is very tight even today. They have this slide in their investor deck that adjusts for their capex and their development pipeline, and it shows that their payout ratio is actually about 95% today. So here you need to remember that FFO doesn't adjust for the capex. So you always need to deduct that to get a better sense of the true cash flow generation potential of a REIT. And in this case, the payout ratio is still very tight at 95%. It leaves no margin of error, and while the Fed has now started to cut interest rates, they are still materially higher than they were a few years ago. And so I think that ultimately this REIT is likely going to have to cut its dividend once again. They may be able to sustain this one for another year or two, but eventually I think that we'll see another cut. And for this reason, I'm staying away from Brandywine and I keep favoring some of its close peers. Hey, before I go into the second REIT, can you please let me know in the comment section below if you enjoy these type of videos on REITs to avoid, or do you prefer me to keep focusing on REITs that I'm buying instead? Your feedback will be greatly appreciated. Also click the like button. Thanks so much in advance. So the second REIT I also expect to cut its dividend is called Blackstone Mortgage Trust, ticker symbol BXMT. I believe from the top of my head, this is the mortgage REIT that's managed by Blackstone. Just like in the case of Brandywine, last year I predicted that it will have to cut its dividend, and it did, I was correct. But again, the same situation more or less. I think that they didn't cut it enough out of fear that this would, depress their market sentiment and their valuation. But I think that they're gonna have to cut it once more in the future because the REIT is facing growing issues. Firstly, they have high exposure to a loan book with office properties as collateral. We all know that those are struggling. I already discussed this earlier in this video, so I'm not going to repeat myself, but I think that they're going to face growing impairments from this office loan book. And unfortunately for them, it's not just the office loans that are problematic. I think that many of their residential loans will also face growing impairments going forward, because just like many other mortgage REITs, it's not just them, but they were too aggressive in lending against apartment communities when interest rates were at near 0% and cap rates were very low. At the lowest point, cap rates were in the low 3s. But since then, interest rates have surged. Cap rates have expanded quite significantly. Now they are closer to 5.5 for the properties against which Blackstone lend money. And as a result, the loan to values, which were safe a couple years ago, have now become very risky. They've expanded closer to 100%. And again, this leaves very little margin of error, especially in today's environment, as apartment communities in the Sunbelt markets are facing some oversupply. And so I think we're going to see also more impairments, not just from offices, but also from these residential loans. And despite that, the reserves that they've set up for these impairments are still relatively low. And I think there's higher risk that these reserves will need to grow going forward. The REIT has quite a lot of leverage as well. And while the payout ratio today is well below 100%, the dividend is covered. I think that this is based on yesterday's cash flow, but tomorrow's cash flow could be materially lower. Another headwind for this mortgage REIT is that interest rates are now returning to lower levels, and many of its loans have a variable rate. So this means that their interest income will actually also come down now going forward. So once again, I think that unfortunately they probably didn't cut the dividend enough, and this is likely going to lead to a second cut down the line. Just like in the case of Brandywine, I think that they might be able to sustain this dividend payout for quite a while, for not just a quarter or two, but potentially even a year or two. But eventually, I think that the dividend will have to be readjusted once again, and therefore I'm avoiding this REIT. And then the third REIT to avoid, I've covered quite a few times on this channel, is called Global Net Lease, ticker symbol GNL. And where to start here? I think that there is almost everything wrong about this REIT. Their assets are very risky. Their balance sheet is over leveraged, in my opinion. Their management, but the management really is the main issue. And you just need to take a look at their long-term track record since they went public, and it's one of the worst in the entire REIT sector, especially in the net lease peer group. They've still failed to earn a decent return to their shareholders despite having been public for a long time. Now, I'll put another chart on the screen that compares their past performance to that of their close peers, Realty, Essential Properties Realty Trust, which have been our top picks in the net lease sector. And you'll see that there's a very drastic difference. Global Net Lease have done way worse despite focusing on the same net lease property sector. By the way, before I continue on Global Net Lease, please note that we interviewed the management teams of Realty, Vici Properties, and many other net lease REITs recently, and you can access them for free as part of the free tier of our REIT newsletter, High Yield Landlord. I'll put a link to that in the description of this video. I will highly encourage that you sign up for it. Just leave your email. You won't get any spam. You'll just get free, high-quality research on the REIT sector. I plan to post more of these interviews going forward there, so that's my little promotion for my REIT newsletter. But to get back to Global Net Lease, they've cut their dividend 3 times over the past 5 years alone, and more even if you extend this time frame. And so I have no confidence that the management will now turn for the better and be able to start growing their dividend or sustaining their payout ratio. In fact, if you look at their current dividend, it's already poorly covered. The payout ratio is around 100%. Again, they have a lot of debt. In the past years, they've bought a lot of assets at very high cap rates to try to make up for the high cost of capital. But these high cap rate properties come with high risk, of course, as well. And I think that if we go into a recession, we may see some of these risk factors play out. And so ultimately, it comes down to the fact that I personally don't have any trust in this management team. It's my personal opinion. I just don't, based on their track record, their past actions, I just don't think that they will be able to sustain their dividend. And for this reason, I'm staying far away from this specific REIT. I think that there are far better opportunities in the net lease sector. And now my final plug before I end this video, we're about to unveil our top pick for the net lease sector for 2025. This article will be part of our top 5 picks for 2025 series, which we are posting on the paid tier of our REIT newsletter, High Yield Landlord. And if you want to access this, you can join us for a 2-week free trial. It will be the second or the third link in the description of this video. You won't be charged anything in the first 14 days. It will give you immediate access to my entire REIT portfolio, all my transactions in real time, and this new series highlighting our about top picks for 2025. You don't want to miss out on it. This is completely free with the 2-week free trial. Again, once more, if you could please click the like button, that will help me a lot. Let me know in the comment section below if you want me to keep doing videos on REITs to avoid. See you at my next one. Bye bye.